So we are privileged to have had Morgan Housel for the second time. Uh, he come virtually 3 years back also, and he needs no introduction. He's probably the most popular non-fiction writer today. His books, I think everyone would have read his books, and even the one acid test of the popularity of books is the number of pirated copies which gets sold at cinema. And सबसे पहले वो दिखाता है the psychology of money. So that's it. In fact, today I met one gentleman. He told me he liked the book so much, he gifted 200 copies to his clients. And at Cafe Mutual itself, we would have gifted at least 20, 30 copies to our well-wishers. And I told, so we're really honored to have him, and he'll be talking to me virtually. The format that we will follow is that I'll ask him a question and then he will answer it. So, can we get started? Okay. So, Morgan, welcome. In your book, Psychology of Money, you emphasize the role of behavior over intelligence in financial success. What common behavioral pitfalls should MFDs or mutual fund distributors watch out for when managing their clients' money?
I think the biggest is all of our propensity to want to be long-term investors. We want to be investing for the next 10 or 20 or 30 years, but the fact is the long term is just a collection of short terms. And if I want to stick around for the next 20 years as an investor, and I do, and I want to be invested for that time, I need to put up with all of the short-term volatility and all of the challenges, all of the surprises that are guaranteed to happen until now and then. I am a long-term optimist. I'm very optimistic that 20 years from now, I'll be living in a better world. You will be living in a better world. All of us will be. Technology, things will be better. But you also have to be very realistic about how hard it's going to be to get there between now and then. And this is such a problem with mutual fund investors because you want to be a long-term investor. That's important. At the same time, you have to, mandatory, deal with, on an almost daily basis, uncertainty and volatility and greed and fear. And so your ability to manage that on a daily basis, even if you're a long-term investor, is what's so important.
Morgan, one of the points that you make, is he there? Yeah. One of the key points that you make is that the relationship that people have with money is deeply personal. Then how can mutual fund distributors approach clients with different psychological approaches to investing?
Well, you're absolutely right. What I have experienced as an investor in the United States is different from what you have experienced as an investor in India. We're all very different, and that is true for anybody around the world. And even within the United States, I have friends who are my age, my same background, we went to the same school, and we have totally different views on the world. We have different goals, we have different aspirations. And so there is not a single right way to manage money. There's never a time when any manager or financial advisor can say, this is the right way to invest. There is no one right way to invest. It is going to be different for everybody. And how I invest my money, personally, might not be the right way for you to do it. Not because I think you're doing it wrong or you think I'm doing it wrong, just because we're very different. So I think that's the biggest way to deal with the fact that all of our personal histories are so different, and therefore we're going to have so many different goals and aspirations, is just understanding that two people of the same intelligence, the same education, equally informed, can come to very different conclusions about what you should be doing with your money.
Okay. Morgan, in your new book, Same as Ever, you argue that certain fundamental behaviors and tendencies, they remain unchanged over time. What do you think are the most critical constants in investor behavior that MFDs should keep in mind?
I think the biggest that I read about in my book is the idea that the biggest risk that you are facing today, you personally, you professionally, the whole global economy, whatever it might be, the biggest risk for the next 12 months and the next 5 years is something that nobody is talking about today. That has always been true. I think that always will be true. That by definition, the biggest risk is what you don't see coming. Because when you don't see it coming, you're not prepared for it. And that's what makes it risky. If we all knew exactly when the next recession was going to come. We would all prepare for it. People would save more money, they would find a different job, they would move to the right areas, we'd all prepare for it, and it wouldn't be that big of a deal. The reason recessions and bear markets and things that are happening in the global economy, things that are happening in politics, whatever it might be, the reason they cause damage is because they are surprising. And I think there are actually no exceptions to that historically. That if you look back at any 10-year period, any 5-year period, and you say, with hindsight, what was the biggest risk during that time? It is always something that nobody saw coming. That has always been like that. It always will be like that. It's always the same as ever.
Okay. But given the constantly evolving nature of markets, how do you balance this idea of same as ever with the need to adapt to new trends and innovations in the financial world? In fact, one of the underlying beliefs in same as ever is that the future is a projection of the past. But with so much happening in the world of technology, with AI, machine learning, and all of it which is threatening to be very disruptive, how do you look at it is still very difficult for us to believe that things are going to be the same as ever. Aren't these technologies going to disrupt the world, including the world of investments forever?
Well, you're absolutely right that things will not be the same in the future in terms of technologies and innovations and what countries are leading, what industries are leading, what companies are leading. That has never been the same and never will. What is the same are the behaviors of how people respond. So I have no idea which company is going to win the AI race over the next 10 years. I have no clue. And there's actually a good chance that that company doesn't even exist yet. But I do know how people will respond to that kind of innovation because that behavior has never changed over time. And if you look historically, how people responded to the car, the automobile, computer, the internet, completely different technologies that came out of the middle of nowhere, don't seem to have much in common, but the behaviors that people put forth were the same. And so I think that's just a better way to think about the future, is rather than asking which company is going to win the AI arms race, because frankly, nobody probably knows, if we're honest about it, is to say, what kind of behaviors do I know about historically that dominate greed and fear during these new technologies, during these market cycles? Let me focus on that and put my emphasis on that because I know it's going to be important regardless of what happens with all the new technologies that are coming down the pike.
Now, we all know that patience plays a majorly important role in the long-term success of any investment, especially given the market volatility. The instinct is to bail out. In this context, how do mutual fund distributors guide their clients to adopt a more patient long-term mindset?
Way is understanding what you get paid for over time as an investor. You can earn good returns in the stock market over a long period of time. We all know that, that's why we're here. So then the question is why? What are you getting paid for? Why is the world giving you potentially a fortune over time? What did you do for that? What is the cost of admission for that? And it's so obvious, of course, when you think about it, that the cost of admission in investing is putting up with and dealing with a never-ending parade of uncertainty and volatility. That's the cost of admission that you have to be willing to pay. And so most investors, I think, when they deal with volatility, they think somebody messed up, somebody made a mistake. My financial advisor, my portfolio manager, the president, the Federal Reserve, whoever it might be, somebody made a mistake here because the stock market just went down 10%. That tends to be the view. But when you view it as, no, the stock market is volatile because that's the cost of admission. That's why I'm going to do well over time, is because I'm putting up with this. That's why there is a return in the long term. Then I think it's not fun, it's not enjoyable. I don't like it when the stock market goes down, but you realize that this is the cost of admission, and you have to be willing to endure it, and your ability to endure it is specifically why you're going to do well over time.
Morgan, you're a guru in behavioral sciences. Tell us, how can the mutual fund distributors here mitigate the psychological biases of their clients, such as recency bias, loss aversion, or overconfidence while making investment decisions?
The honest answer is I think we can't. There's no ability for anyone to read a book or read a blog post, whatever it be, and change the fundamental wiring of their brain in a major way. So I think, and that's actually not a bad thing. This is not a difficult thing to come to terms with, because rather than saying, I'm gonna fix all of my biases, that's just denial about the biases that you have and that I have. I think it's way better to just embrace them and come to terms with them and have a financial plan that accepts them. So if you are the kind of person, if you or your clients are the kind of person who panics every time the stock market goes down 20%, rather than trying to fix that, you should just learn from that and say maybe you shouldn't have more than half of your net worth in stocks or whatever it might be. And I think that is a much more realistic way to deal with it. I think a lot of people, when they are young in their investing journey, think that they can fix all their mistakes. Oh, I learned from that the last time. I did the wrong thing, but next time I'm going to do the right thing. Sometimes that is the case. More often than not, though, you're probably going to do the same thing next time, because the way that you interpret greed and fear and risk is going to come roaring back during the next bear market. Like, those fundamental attributes don't really change that much over time. And I know this about myself, that how I felt psychologically in 2001 during that crash, 2008, 2020, all of it was pretty much the same. I've learned so much about investing during the last 25 years. Of course, I've learned a lot, I've changed a lot, but the actual wiring of my brain and how I think about risk and worst case scenarios really hasn't. So rather than changing it, I just try to embrace it, and I think that's what everybody else should do too.
Morgan, you make a reference to the fact that most investors are influenced by greed and fear. So how can financial advisors manage these emotions in their clients so that they produce better investment returns?
I think it's almost inevitable that there's going to be. This is something else that's the same as that. And we're never going to get to a world where any large number of investors no longer have greed and fear. I mean, it's such an ingrained behavior within it. I think if you are an investor and you're managing a portfolio, it's best to just use that to your advantage and buy a little bit more when things are down, and buy a little bit less when things are up. It's simple, basic stuff like that. I think that's the best that we can do. I think just understanding why fear and greed happens is a big part of this. And then when it does happen, you're not surprised and overcome by it. So if you realize how inevitable it is, that people cannot stay in a calm, happy medium. It's always going to be overshooting to the upside or the downside. It really has to be. No one is going to sit at a calm, medium state, at least for the whole global economy, because if there's opportunity, they may have missed it. And if there's a risk, they don't want to miss it. So they're always going to be going way too high, way too low. It's inevitable. It's always been like that. And I think just understanding how inevitable it is makes it so that when it happens, it's a little bit less scary than it otherwise would be.
Okay. One of the things which fascinates me most about your books is the fact that they bring new insights into managing money. So in the earlier days, people used to write books on fundamental analysis. They would read up these books on fundamental analysis, and then they would go and they would research stocks, and they would understand companies, they would understand their businesses, their business models, understand the financials, and so on. So this used to produce great results when fundamental research was first discovered. However, over a period of time, all of us have become good at fundamental research. When I say all of us, I mean a significant part of the market today is driven by fundamental research, and this has become something which is par for the course both on Wall Street and in India. So do you think that for the next level of knowledge would be overcoming behavioral biases, and that would lead to producing better results? And what if everyone reads your books and learns from them? Would everyone then would we come at a place again where an equilibrium a state of equilibrium is reached, where no one has any advantage over others, because I control my behavioral biases, he controls his behavioral biases, she controls her behavioral biases, and then we're all together. We read the same book, we apply the same principles, and we'll all become so good at it that now no one can produce market-beating results. What do you have to say about that?
I hope so, but I think the answer is no. There's a great quote from the philosopher Schopenhauer who says, the wise have always said the same things, and the masses have always done just the opposite. And he said that like 200 years ago. And I think if you look at what a lot of Stoic philosophers said 2,000 years ago, it's the same things. It's the same things that people are saying today, but they're just as relevant today because nobody does it. And so I think a lot of this is just such a normal part of human behavior that there's been a huge revolution in behavioral finance in the last 20 years. Kind of started with Daniel Kahneman, Jason Zweig of the Wall Street Journal wrote a lot about it. And so what looked a little bit revolutionary 20 years ago, has there been any improvement in investing behavior? I don't think the answer is yes. And I think actually you could say it's the opposite. That now we have Robinhood and day trading, 0-day options and crypto and all that. You could even say that was a digression in investment behavior over time. Even if some people are doing it for the right reasons and they're having fun, I don't judge them. But I don't think you could look at the current state of markets and say, wow, in the last 20 years that we've learned from Daniel Kahneman and Amos Tversky and all these people, we've actually gotten better. There's no evidence of that whatsoever. And I would expect that to be the same 50 years from now. So I think these behaviors, even if it's new technologies, new markets, new economies, new political structures, different wars and recessions, whatever it might be, those will always change. The behaviors, I think, never will.
Okay, Morgan, now I want to ask you a few questions as Morgan, not the book author, but as Morgan, the investor. As a writer and financial thinker, how do you maintain a balanced approach to your own personal investments? And how do you face the same psychological challenges as the rest of us lesser mortals?
Yeah, and I think in many ways, my writing is just a reflection of what I've experienced and what I've dealt with. So when I talk about investing fear and greed and all that, I'm probably writing about myself. Now, I've been very open about how I invest. I dollar cost average into index funds and I leave them alone forever. I've never really sold anything, and I hope to own them for the next 50 years and hopefully I'll give most of it away to charity. That's kind of the plan right now. So I think I have followed the advice of long-term, patient, that kind of thing. I'm a big saver. I've been a big saver for my entire life. But do I feel fear in March of 2020 when the world was melting down in the early days of COVID? Of course. Do I fret about the uncertainty of what AI is going to do to the economy for my kids' careers? Of course, yes. Am I unhappy with the current political state in the United States? Of course, all of that. Back to Daniel Kahneman, who we were just talking about. Somebody asked him many years ago. It was an interview that I was at, and they said, "Dr. Kahneman, you study behavioral finance. You know this stuff more than anyone. Has it helped you make better decisions with your finances?" And he was like, "No, not at all. You can study it, but that is a different thing from saying I can become a monk about it and perfectly implement this in my own life." I think being aware about it is very important. And so when I have those feelings of fear, I think I'm able to compartmentalize them a little bit more than I used to be. But that's not in the slightest to say that I don't feel them. Of course I do.
I hope you know that you're phenomenally popular here in India. In the non-fiction genre, you would perhaps be the best read author since your book, Psychology of Money, came out. Are you aware of that?
Yes, it's a wild thing because it's India. If I look at all the global economies where my books sell, India is definitely a standout. So thank you.
Okay. Could you share with us which is the next book that you're working on? Is there a concept you already have in mind, or have you already started working on that?
Yeah, I've written another book. It'll come out later this fall. It'll be available in India this fall too, of course. It's called The Art of Spending Money. Very similar to the Psychology of Money, but Psychology of Money has a lot to do with investing. And The Art of Spending Money is everything about money that's not investing. It's saving, spending, how we think about greed and fear and keeping up with the Joneses and social aspiration and what kind of spending makes you happy. Why are you so driven to spend more and want more? That's what I dig into.
Okay, that's interesting, and I look forward to the book. But before I end this interview, our audience here is largely mutual fund distributors. If you were to offer just one piece of advice on how to better understand their clients' financial behaviors, what would it be?
And The Art of Spending Money is everything about money that's not investing. It's saving, spending, how we think about greed and fear and keeping up with the Joneses and social aspiration and what kind of spending makes you happy? Why are you so driven to spend more and want more? That's what I dig into.
I think I'll have to repeat the question. Repeat the last section. So that's interesting, and I really look forward to your next book. But before I end this interview, our audience here is largely mutual fund distributors. And if you were to offer just one piece of advice to them on how to understand their client's financial behavior, what would be it?
The future will be better than you anticipate, but it's going to be a hard road to get there. That has also always been true and always will be true. And I think it perfectly describes the psychology of every investor. I'm investing because I know the future is going to be great, but I'm a bad investor because I get scared out of the volatility. That's the path for so many different investors over time. And I think there's understanding that dichotomy, that divergence between optimism and pessimism is probably the most important thing to understand about the psychology of investing.
So with this, thank you, Morgan, for spending your time with us. Thank you so much. So let's have a big round of applause for Morgan.